Hello and welcome to Sarwa's Investment Academy. In this video, we'll explore how to approach making your first investment. When it comes to making your first deposit, there are a few key considerations to keep in mind. Let's dive into two important variables, which are how to start and lump sum investing versus regular contributions. How to start? When it comes to making your first investment, a smart approach is to combine a lump sum investment with regular contributions. By investing a lump sum up front and consistently adding to your investment over time, you can benefit from the potential growth of your initial investment while steadily building your portfolio. This strategy allows you to start building your investment portfolio sooner and take advantage of the power of compounding. Now, you might be wondering, what's the ideal amount to start with? Well, the answer to that varies for every individual. But a good starting point is to allocate any funds beyond your emergency reserves or near future expenses. By avoiding excessive amounts of money sitting idle in a bank account, which will likely be eroded by inflation, you can put your funds to work and potentially earn higher returns. For regular contributions, many people find it helpful to aim for around 20% of their monthly income. A great way to think about it is that if you're paying yourself every single month, you make great inroads towards your financial goals. Every single month, you have the opportunity to pay yourself. Having this disciplined approach ensures that you consistently invest a portion of your earnings, which helps you stay on track for your financial goals. Now, lump sum versus regular contributions. In the investment world, the decision between the two has always been a subject of debate, and that's because each approach has its advantages based on the individual's circumstances and goals. Lump sum investing can be very beneficial if you have funds sitting idle. By investing that sum up front, you can potentially take advantage of market gains and compounding sooner. It allows for immediate exposure to the market and the potential for higher returns, especially in periods of market growth. On the other hand, regular contributions also offer their own advantages. By consistently investing small amounts at regular intervals, you can smooth out the impact of market fluctuations. Regular contributions promote discipline and allow for a more manageable investment experience. It enables you to build your investment portfolio gradually while staying consistent with your financial goals. Remember, both approaches have their merits, and it's not necessarily a matter of choosing one over the other. However, combining the two gives you the best of both worlds. You invest idle cash up front and top it up every month to make your money work for you. To summarize, here are the key takeaways for making your first investment. Number one, consider your financial situation and goals to decide whether a lump sum or regular contributions are more suitable for you. And number two, if you can combine a lump sum investment with regular contributions to kickstart your investment journey, this would be a great approach and to help you achieve your financial goals. Congratulations on taking a first step towards investing.